Welcome to Digital Currents, brought to you by Morgan Creek Digital. I'm Xavier Segura. Each episode, we spotlight the topics and people changing the tech industry with a focus on AI, blockchain, chips, and big data. Thanks for listening, and please make sure to subscribe if you like what you hear. And remember, stay current.
Hi, everybody, and welcome to Digital Currents. Mark, it's not our usual day, but we're doing our best to just think like it's Friday.
That's right. Well, and it's obviously not our usual day. And I do own more than one shirt. I am wearing the same shirt this Tuesday as I was last Friday because my wife is so efficient at getting stuff back in my drawer, and I like this color. But I am in the office today, not at the home office, but I did manage to keep the sock game on. So I'll do the quick review.
Excellent.
So no orange pants, but we got white today.
Excellent.
But we have the Bitcoin whale sock game today. And the reason for that is if you look at, they call them new whales, so above a certain number of Bitcoin, that has gone totally parabolic. So the OGs are starting to sell a little bit here and there, but there's a bunch of people accumulating, and that's Bitcoin treasury companies, that's individuals, that's the ETFs. So there are a lot of new whale wallets in the Bitcoin land, and despite the continued volatility in prices, the thing that's, I won't say it's alarming yet, but it is starting to look like a trend that may become alarming, is the amount of Bitcoin left on exchanges for sale. I mean, we're plumbing new lows, and this week, no, not this week, last week, 37 new companies declared intent to become Bitcoin treasury companies.
Wow.
There were already 130 odd-ish and 37 more. And there's more to come. There's a couple of big announcements coming later this week, next week.
And to that point, Mark, you got to imagine that's just going to continue, because if you're sitting on the board of a company as we do, and the company is either good or bad, looking for an alpha generation strategy, and you look at the competitor set, and they are all increasing an asset that is available but yet scarce. I mean, I'm not going to ask you what you would do, because I know what I would do.
But it's logical, and
right.
And there's a game theory piece of it, which is, to your point, if you're on the board of a business and all your competitors are doing it, now that's the old thing that your mom and dad told you. Just because everyone else is doing it doesn't make it right. I'm like, well, kind of in business, that's not necessarily true. It kind of is. I mean, if people, now, again, if it's illegal or immoral, fine. But this is standard business operating practice where the light bulb is going off around board tables around the world that, hey, this asset that most of us have been very comfortable with since, the beginning of time, cash on the balance sheet, actually isn't what we thought, right? It's getting less valuable, and the extent of that devaluation is going crazy. Now, I someone said they missed me talking about chart crimes. I used to talk a lot about chart crimes, especially in the chart of the day. Okay. And you haven't had any chart crimes, so you're good. But one of my things that just drives me crazy is when people take long-term charts and don't use log scale. Because a long-term chart that looks parabolic is meaningless, because the difference between going from 100 to 200 is very different than 200 to 300, 300 to 400. And log scale is necessary over long periods of time. And so the growth rate of any asset can look really crazy on a long thing without log scale. So people post the chart all the time of the debt or the interest or the number of dollars. And someone posted one from 1776.
Oh boy.
The other day. So I said that might be the greatest chart crime of all chart crimes, because if you're talking 249 years, you have to use log scale. Like,
Oh yeah.
you can't post a regular chart because all the numbers on the left-hand side are totally meaningless. But the point they were making is, well, your point's not that valid because, the increase in dollars is really big in the last 20 years. I'm like, yes, but remember, a dollar was a dollar from 1776 to 1913. There was no such thing called inflation. There was no fiat currency. We were on a strict gold standard. You could not create money out of thin air. And so there was no fluctuation in currency. And so when you take that piece of the chart away and you look since 1913, a dollar is now worth about 2.5 cents. And so, yeah, it takes a lot more of them to do anything. And, we've all experienced it buying pretty much, anything, lunch or coffee or whatever. And so I think if you're a corporation, you say, oh, I'm patting myself on the back. We got $200 million or $200 billion if you're Apple in cash. Like, well, okay, but now it only buys $180 billion worth of stuff or $160 billion worth of stuff. That's not very good stewardship. And the aha moment for Saylor was, if I swap that cash to Bitcoin, then I get more purchasing power over time. And it's worked in spades. And I love when people try to throw shade on this and say, oh, but when it goes down again, then it won't work. I'm like, well,
In the meantime.
in the meantime, right. And singular volatility doesn't exist in a vacuum, right?
Right.
Yes, there will be downside volatility at some point, but you don't stop time, right? The time just keeps going. Seems to be going faster, by the way, as I age. But anyway, so
Yeah, I think what we're seeing here, Mark, and what's nice and a blessing in disguise in being able to record orally, because we've got some holidays coming up, office closures at the end of this week, so we wanted to make sure we're giving our audience the best of what we can cover. Sometimes, Mark, it doesn't always fit into 1 hour or hour and a half, so that's why we joke we're thinking about doing the telethon. And I think that could be cool. But one story, Mark, that we were remiss not to discuss last week is Chime. So the IPO season is back, and we had a chart of the week a couple of weeks back where we're kind of looking at what were going to be the ones to watch. And Mark, I feel like I have seen that chart for several years now with those names, right? That we were waiting for some of these companies to go.
Oh, yeah.
We're waiting for Corey, waiting for Chime. And now they're here. And they're not just here, Mark, but they're doing awesome, right? The cynic in me might say, well, Mark, does this mean something like Chime? And it's it IPO'd on Thursday. We recorded in Friday. Does that mean that, that the bankers got it wrong? They were too pessimistic, so it's doing well. Basically, that's the new fair value. My heart of hearts would say that's not the full picture here, right? I think what we're signaling here is that good companies are going to remain good buys if they have good technology. And something like Chime is doing well. It's not quite, Mark, in our ABCD thesis. I wanted to include it as part of this broader exit opportunity. And the reason that I mentioned it's not quite there is because we have been very quick to point out that the neobanking companies are not revolutionary. They're evolutionary.
Evolutionary.
Right? So they're going to continue facilitating transactions, albeit with fewer fees that are a little bit quicker, but using the legacy Rails situation, but that will get you alpha. And so maybe we can kind of quickly discuss, what's going on with them. I think, with Chime, this is one that, was valued at 18.4 billion. You had a huge jump as much as 59% on the opening day. It's since cooled a bit, but it's doing quite well. And this is really helping users also drive adoption in the Web3 side. So it's crossed over that, even though it's got some of these legacy Rails. It'll allow you to do things within stablecoins and within wallets, but then have like a, low cost user controlled finance. Like we said, it still operates on ACH, but the stablecoins are this USDC and obviously the PayPal stablecoin. Mark, this is reminding me so much of when you and I first got together here and thought about investments in Figure. You heard this phrase, Web3 light or Web3 influenced and adjacent.
Yeah.
I feel like this is really kind of a snapshot, a selfie in time, which is you have companies that are Web 2.5. And I look at Chime as kind of being...
Yeah, look, it's, I made the joke that I stole from somebody. I wish I could give him credit, but I don't remember who said it, that, we've had 20 plus years, 25 years of fintech. And the reason you put it in air quotes is because there's no tech. And it's a better UI UX on the front of these ancient, Rails that still use the fax machine and ACH and Fedwire. And yes, it is better to have it all in the palm of your hand than having to go into the bank. Like literally today still, if I want to wire money out of my account at this little bank in North Carolina that we bank at, I have to go into the branch, which is insane. And in an app in my hand, I can do that anywhere. And there's a little bit of creep away from ACH into, hey, well, maybe I can have a bucket of stable coins and I can make those payments instantaneously 24/7. I don't have to wait for bankers' hours. You've all heard me bitch and moan about the transaction. Took me 10 business days. I mean, literally 10 business days.
Unbelievable.
Had another fun one. I withdrew some capital from my brokerage account and I sent it to my bank, and it went out of my brokerage account last night, showed up as pending in my account this morning at the bank. Like, well, okay, so it's not there yet and I can't use it. So who's using? And I did the math. When interest rates were 0, who cares? But at 5%, I mean, that's real money. And I just find that interesting. And look, I know the game of financial services has always been about the float, right? It's like Starbucks. One of my favorite things is, we all load our Starbucks card. Why would we do that? Why would we give them that money? Because they take it from Visa and MasterCard and then they earn interest on it. And, most of us keep, 25, 30, 40 bucks on there, whatever. That's not that big a deal. But when you multiply that by tens of millions of users, that's a lot of money for Starbucks. But the one that gets me, there was this thing a few years ago where it was a flex to show how much you had on your Starbucks app. And there's one kid in Beverly Hills who showed his app with like $18,000 on. I'm like, okay, so you're an idiot. I mean, okay, yeah, you're rich and your parents are rich, not you, but your parents are rich, but you're an idiot. And, you should be grounded for taking $18,000 out of the bank and giving it to Starbucks so they could earn interest on it. And I get that that's all part and parcel, but as we migrate to true Web3 and beyond, using things that we control. Jack Dorsey just said this past week that, Bitcoin makes it so we don't need banks. And that's nothing new. We've all been talking about that now for years. But when you say it out loud, it's a little adversarial. And if you think about it, it's kind of true. I mean, the Bitcoin ledger does allow for us to free ourselves from not just JP Morgan or Citigroup, but actually from Chime or SoFi or anybody else. And I'm not saying everyone needs to do that tomorrow. And BYOB, not the old fun days of partying, but bring your own bank or be your own bank. But we are moving to a decentralized future where all of the microtransactions occur on chain, where all of our assets, our wealth, are on chain. And I'm sure everyone's seen the picture, right? Total assets in the brick, and that's now 1,000 trillion, which is a quadrillion. And Bitcoin's this little upper square at 2 trillion. So yeah, it's it's 20 basis points of total assets in the world. How big is that orange box going to get of the total box?
And so here's the stat, Mark. I kind of open up the question about when we look at kind of this IPO activity, is something like Chime having a good day and a good, subsequent day, opening a good week, signal of the pricing just being a little bit bearish and the market catching up to what is fair value? I'm going to make the argument that no, it is not, because IPO markets now are the strongest that they have been in 4 years. Now I'm going to quote to make sure it's not a chart crime, because strongest relative to what? Because basically in 2022, 2023, 24, we had a relatively slow market. We all know that. But if we look at as of, last week in the US, we raised $25 billion, right? And if you look at how that compared over the same period, the last 2 years, you're at 18 and really bad, under 10 at 9.5 billion. So if we can think about this as a chart of the week, we have something else prepared, but maybe we throw up the visual. The question is, well, how are some of these faring? And we actually have horses in this race. eToro still continues to do really well. Some could argue it was priced, a little bit lower. Others would say it was priced fairly because it continues to be strong.
I'm going to take a little bit of the other side, not to
let's do it. Now let's have a conversation.
Not to disagree, but just look, I actually think these valuations were fair to aggressive.
Mm-hmm.
And now we've gone to a little bit silly town. Now, it's not as bad in eToro or Chime's space as Circle. I mean, Circle's 5x'd since the IPO, which was only
crazy
weeks ago. And look, Circle's a perfectly great business. But it's not worth what is being valued at today. My favorite stat, and it's probably now 3, but last week, Tether earned more in 4 days than Circle did last year. Now it's probably 3 days, given how crazy overvalued the asset is. But I guess that wouldn't change it. But the Circle is, it's a good business, but it's not. It's kind of like a grocery store, right? Skinny margins, but you make it up on volume. And that's a great business to scale, and it can create meaningful wealth, but it shouldn't trade like a tech company. Although I love the fact they called themselves Circle Technologies.
Oh, wow.
Really? Come on. I mean, but everybody does that. Figure Technologies, Chime is SoFi, SoFi Technologies. SoFi?
Right.
Really? I mean, it's not, I guess there's technology involved, but putting it in your name just so you can get a tech multiple or a fintech multiple. So anyway, so if you look at equity valuations broadly, we're in the top 7 or 8% of all history, like too expensive. And the period since the lows after the first salvo with tariffs is the biggest fatness, the fastest rise. No, third fastest, the third fastest increase in the history of markets, which is kind of crazy because fundamentally nothing changed. It's just that the crazy talk of tariffs kind of disappeared. And now we're kind of in that limbo land of, do we have a deal? Do we not have a deal? I'll argue we don't have a deal, but it doesn't matter because they're not going to do anything because they're both on pause, which is the permanent pause. So I'm a little bit hesitant to say that all of this good things that are happening in the equity markets is necessarily good because two challenges. One, most of the buying is buybacks and ETFs, which don't think. And the buyback number was big, like bigger than the last 10 years by far. That's about to cool as we go into Q2 earnings season. So that'll be interesting. The second thing is insider selling, has exploded. And one of my favorite lines is insiders don't sell at bottoms, right? If you know a lot about a company, you don't sell unless you think it's fairly valued or even overvalued. And so those two things make me nervous. And think about it. When do IPOs peak? In undervalued markets or overvalued markets?
Correct. And there's no
peak
better
in overvalued markets, because if you were going to take your company public, you'd rather take it out at a high value than a low value. And investment bankers for sure like to take you out because they get a percentage of the money they raise.
No doubt about it, Mark. And I think you illustrated the point perfectly that I wanted to get to, which is this idea of, well, what does a normal kind of IPO environment look like? I think we've been suppressed for such a long time that it gives us a little bit of a worry about, what's to come. There have been some, like I said, good companies are going to continue to perform well relative to the macro environment. But I think also, to your point about selling when the market is at its peak, this is personified, none better than I can think of than 2021. I think 2021 really kind of helped us get away from what would be a normal condition of an IPO market. And we have been sort of thinking about, can we get back to this state? And the short answer is no, right? We will not go back to 2021 and why that was such a huge year. If you plot on a chart what the number of IPOs and the deal value was, it's something like 506 deals, right? Relative to like over the last decade was averaging, around 100-ish, through kind of the first half, right? So it was something like, four times greater than the average. And then also the deal value by raise also significantly higher, around 175 billion. And so, some of the conditions we speak about are ones that won't likely be repeated. Excess liquidity, low interest rates. These are kind of foreign concepts to us now at this point, Mark. Our retail.
We're back. We are back to normal, which is good. Having too much liquidity and basically free money is not a good thing, right? If every company can get refinanced, then the bad ones don't go away, and then they choke off the market opportunity for the good ones. And I always use the example here in North Carolina, right? They do occasionally the controlled burn, because it's such lush forest that if you don't burn away the brush, then the strong, healthy trees can't really grow. And I think the same is true of economics, right? Economics needs to function. And you should let the market determine the clearing price of every good or service. That's the way markets are better. Adam Smith was right. And so the fact is that when you suppress the price discovery, you get bad outcomes. And when money's too cheap, you get a lot of zombie companies. I mean, here's the crazy thing. 42 or 43% of all the small cap companies that are listed in public markets today don't make money.
Oh, wow. Didn't know that.
It's a crazy stat. I mean, they literally not only can they not pay off their debt, right? They could never pay off their debt. They can't even service their debt. So the only way they can survive is to issue more debt to pay the debt. Kind of sounds like governments. And that is literally a Ponzi scheme. And that's actually the correct usage of the word Ponzi scheme. I mean, people use it for Bitcoin or whatever. It's not, or Solana. It's not. That actually is. If you have to borrow money from someone to pay off money that you owe, that is a Ponzi scheme. And, we call it Ponzi finance in the sense that, people have heard this story before, but in the olden days, right, the banker knew you. They lived in your neighborhood. They knew you, your family, what where you worked, and they underwrote you to pay off principal and interest. That's called hedged finance. You actually expect to get fully paid back. Then we went into a period where the banker kind of moved away because it became, big national companies instead of local banks. And you didn't really know, and you were just a name and a number. And now they didn't really care if you paid back the principal as long as you paid the interest. Okay, that's called speculative finance. Well, then we went to this era that we're in today where people will lend money and they don't care if they get the principal back or the interest. They just want you to refinance it and, pay it off like a bullet loan at the end and let it be someone else's problem. That's Ponzi finance. When you don't actually think that the underlying borrower can pay you back either principal or interest, that is not a sustainable system. And one of the things Michael Saylor did in Vegas, which I thought was actually pretty clever, is he got up and talked about how the capital structure of MicroStrategy, and now the others like Metaplanet and others that'll copy it, is completely disrupting traditional finance in that if you think about the debt of a typical business, right? What's it secured by? Well, it's secured by the business or the assets of the business, property, plant, and equipment, all of which depreciate over time. Business that can be fluctuating. He's like, my debt is backed by Bitcoin. So think about it. You've got a perfect asset backing this convertible bond that's paying you 8% interest. So you could go get a asset-backed loan backed by a bunch of used cars, like Carvana, and maybe you get paid, probably you get paid, but not. Whereas with the Bitcoin, you're definitely going to get paid. So he says, I'm going to take a huge share of that box over here that is traditional bonds. Like, yeah, you kind of are. Now, the hyper-Bitcoinization people would say, oh, well, eventually that orange is going to just take over everything. I'm not quite there yet. I do think we're always going to have businesses. We're always going to have innovation. We're always going to have, companies that do generate profits. But if you're an unprofitable company, people should say, no, I'm not going to buy your debt anymore. That would be a good thing. So anyway.
Well, I guess one point, Mark, that we can kind of revisit is history repeating itself? And you raise a lot of fascinating points that I want to pull apart is when we think about the market then and now, 21 and 25, because we're way better than we were in the last couple of years. IPOs have sort of started swinging back. In 21, the macro environment was perceived to be stronger just in terms of what stocks were doing. Interest rates were relatively low, which generally is a sign that people should be spending more, although you can debate if that should be the case. But really now I'm thinking about this, especially as we have other companies looking to debut. So Coinbase, follow this logic, Mark. Coinbase was the first to kind of really break ground, and they were doing it then at an all-time record high, right? It was in 60, I think Bitcoin at that point was like in the 60s, maybe 63, 64. eToro comes in when Bitcoin is what? At a new all-time high. Gemini is speaking of going in. Kraken is speaking of going in. So at one side, there is definitely seeking momentum. When that opportunity is there, to your point, people are going to come in when it's higher. But if you zoom out a little bit in terms of, well, what are these companies doing since? You had some pretty big names in 21 make their debut. Obviously, we mentioned Coinbase. They're pretty much around similar pricing to where they were a couple of years ago. It took some time for them to recover, but they're okay now. Robinhood is a little bit underwater from where it was because we had the rise of the retail traders right at that time driving volume. Rivian, which is an electric car company, is down. Bumble, a dating app, I guess Love is lost because that's also down. SoFi is down, and Affirm is kind of somewhere in the middle with also Toast being down. So the companies, listen, they're still around. I think a lot of things went down in that period, but as we look to see, to your point, which is a good one, are we repeating ourselves? I will just kind of leave this carrot as a food for thought. SPACs were also huge during this period as a way of people looking to, capitalize off of economic opportunity. You had hundreds of them getting launched. And now you're kind of combining two of those features because there's a company in our space called Tron, which is kind of a DeFi-related company. And they are looking to go public by what? By way of a reverse merger, which is not quite a SPAC, but it's a similar idea to using a public idea to exit. So there's some shades of 21. But Mark, if you had to ask me, do I feel that the conditions as an investor, do I feel more comfortable in this market versus 21? I feel way more comfortable. I think that the fundamentals are a little bit more established. People are understanding kind of the qualities here. And I think in 21, the world is a weird place. We're still kind of coming off of these lockdown restrictions. There's still a lot of free money companies we're using to do stock buybacks to inflate prices. Whereas now I think we've learned our lessons a little bit, but I'll give a bit of a foreshadow and we'll talk about our chart of the week at the end on AI evaluation. So maybe we haven't as a quote, undefeated.
It's all really important points in that I've argued for a long time, low interest rates are a sign of economic weakness, not of strength, right? You look around the world, the countries with the lowest interest rates, like Japan, have the weakest economic activity. Okay, that's just fact. And the countries that are strongest, like India or China, in terms of growth, have the higher interest rates. Now, China's had some problem with their interest rates, and India's been okay, but generally speaking, I agree with you. Rates today are indicative that we're in a better place, and GDP is rebounding here in the second quarter after a dismal first quarter because of the tariff mess. But what I think is really interesting about the trading and you said Robinhood. Robinhood from 21 to 24 fell 80%, 80,
Same.
right? Then it rebounded a lot, went up, 3 times to get back to flat over 5 years. And in the last 6 months, it's doubled. Okay. Amazing. Because people have become, more fixated on short-term trading. Mm-hmm. Charles Schwab over the same period is up about half as much. So people are leaving the old world and kind of shifting a little bit to the new world. But the one that is just amazing to me to watch is Interactive Brokers. So Interactive Brokers is up 5 times over that same period. And it's a 45-degree line. Well, why? And I only learned this recently. It's because it's not a regulated broker dealer like, these other, UBS or Schwab or, Bank of America or JP Morgan. And so they kind of sit outside this regulatory apparatus, so their costs are lower. But the thing that's really interesting is they facilitate interaction, hence interactive brokers, with multiple market makers and multiple exchanges so they're not an exchange, they're a trading company. And a trading company, they can charge you fees everywhere. They can charge commissions, and they can charge usage fees, and they can charge spread. And it's why there's a great article recently on Citadel. Even my wife, who's not a finance person, was like reading it. It's like, this is fascinating. This guy, Ken Griffin, he's amazing. Like, yeah, he is the smartest person I've ever met. And, again, we didn't give him money in his dorm room, but like the next year, back in 96, 97, and so we had money with Ken for a long time, but what he has built is maybe the most powerful machine in the history of financial services, because he recognized that market making and processing information and being a trading company and like paying for order flow and all these things were really important. And the reason I say he's the smartest guy I ever met, I said, Ken's unique. He's a better accountant than all his accountants. He's a better trader than all his traders. He's a better lawyer than his general counsel. He's just good at everything. And there are just very few people in the world like that. But he sees opportunity and then he acts. A lot of us have good ideas, but sometimes we don't act on it, right? And an action is what creates. And so one of the things that's changed so much in investing is the duration has shrunk, right? You used to invest and you didn't touch it for years, and then it was, a smaller number of years, and then it was months, and it was days. Now it's like hours. The crazy thing, 24-hour expiration options have exploded. I mean, I think I'm going to get this right. I think it's 50% of like volumes are 24-hour options. Now, 85% of options expire worthless. So most people lose money on options, but who makes money on options? Ken Griffin and Interactive Brokers, because they're taking a piece of every transaction by making markets in those options. And that's the genius of those types of models. So as we migrate into a world where we'll do more direct transactions, some of that expense that we all pay, that $7 trillion a year of friction, goes away. Now, what does that mean for firms like Citadel and others? Well, it means they'll probably be less profitable than they've been, but it also creates opportunity for these platforms of the future to charge fees in places that provide convenience and safekeeping. It's a scary world of pure DeFi. Like when you hit that button and you're waiting to see that your Bitcoin shows up in cold storage, it's like, what if I made a mistake in all those characters? What if I put one wrong character? I mean, so there's some still UI UX stuff that this is going to be valuable.
Yeah, and another deal that we missed was an M&A opportunity with Salesforce. So they bought Informatica for $8 billion, and I needed to give this one some shine because it is, in my estimation, one of the few big data deals that we have seen. So last week we profiled Big Red by former company Oracle, and spoke about how this cloud migration is still very much upon us. It's not yet a foregone conclusion that every company will migrate to the cloud, and moreover, that every company has already migrated to the cloud. There are many that are not yet there and won't be there for some time. But Informatica is part of this Salesforce innovation mark. Do you know that Salesforce has acquired multiple companies this year in the AI space for billions of dollars, right? And now this is another one in the same stack. And so, the street liked this opportunity because it basically showed that their data management software tools could help Salesforce improve the quality of its AI force. And if you're ever wondering, Mark, or people that are listening, like when Salesforce acquires something, what they're going to call it, basically they have one word and then force at the end. So, when they talk about AI, it's agent force. So it's not very creative, but there is a good, branding on there. So this is all about proper data governance and ability to manage and, to your point, contextualize the data. And so if you look at, their purchasing here, it has really been firmly in this idea of data management, data services. And, why is that important? Because organizations need CRMs. In particular, organizations that have sales, which is basically like every organization involving financial services. And so we're increasingly seeing, okay, AI might take away more jobs, but it'll also create more jobs as we figure out ways to just become more efficient. So I want to at least spotlight that one because Salesforce is a company that people forget about. I know I forget about them. I think we should have a series on forgotten tech companies, starting with Oracle. Now we're going into Salesforce. But, $8 billion is nothing to sneeze at. And I think this is a pure infrastructure play that is really going to build the agent force ability to just help people sell better by just cleaning up data.
Look, one thing that Salesforce has done really well historically is anticipate where these big needs for software integration were going to be. Take that. Having a database of your contacts, okay, that's not really that innovative, but making it more intuitive, making it more user-friendly, again, having better UI, UX, being more ubiquitous, having it, it's kind of like when Bloomberg first started, they had this one little niche that no one really understood, and it was Bloomberg messaging. And it was kind of before email was really a big thing, iMessage, and so if you and I had a Bloomberg terminal, we could send a message to each other. And so if some other provider came in to say, hey, I got better data, I'm like, no, because then I can't talk to X. And so that was a really sticky thing. And kind of the same thing is if you've got systems that get integrated into the force, may the force be with you, right? Then you're less likely to switch. So yeah, maybe somebody comes in with a better, calendar tool, but if your calendar's linked to your messaging system that you're sending a message to all your people, through the CRM, you're going to be loath to change. Adobe was kind of a similar thing, not through messaging, but Adobe was incredible at adding on other businesses and just keeping that machine just rolling. Same thing as Oracle. One thing that's interesting though, so all of them had the same shape. It's just for years and years of just this accumulation. Oracle kind of kept going, and we talked about that last week.
Right.
Salesforce and Adobe both hit a wall in COVID. And it makes some sense, right? I mean, people, were struggling with what to do in offices and businesses and work from home. So they kind of had this volatile period over the last 5 years, and they've basically been kind of flattish. Interestingly, a company that had been given up for dead and that, Stanley Druckenmiller said was the easiest short he'd ever seen, IBM, has actually started going like this over the last 5 years. And there was a story that for like the previous 15 years, IBM had been dead flat and Salesforce was up 10 times, even though IBM's revenue and profits were not that different from Salesforce. But the woman who ran IBM never went on TV, never talked to reporters, never talked to the press. And Benioff, every quarter, he was out there, Mr. Cool on TV. Well, now, interestingly, we're talking about IBM. I mean, IBM, again, was left for dead, and they've kind of gone into blockchain fabric. And so it is interesting to me how good leadership, Microsoft's another one. Microsoft had been dead money for 20 years. Satya comes in, and I think the thing's up sixfold, something like that. And I'm not saying it's good value here, but it's, Jeff Ubben at ValueAct bought it And I mean, literally like the day that I can't say his last name, showed up, and Narendra, something like that. I should know that. He's one of the most famous people on the planet. I should know his last name. But you know, my guess is Value Act is long since gone from Microsoft. I don't know that for sure, but I would think, they made their 5 or 6X and they move on to the next idea.
Yeah. I think it's a good segue, Mark, is I think today we've been talking a lot about like what do IPOs look like as part of this broader market construct, but then also kind of what is driving the growth within the company itself before it gets to the point of being a publicly traded entity, and what does that look like? And that's firmly in the business of venture capital, where we think about, okay, what are going to be those next trends that are going to drive value into the next decade, really, right? Because most funds are 10 years. So we have to kind of think about this, but realizations happen in as little as 3 to 5 years. Although results not typical, I'll make sure I'll put that disclaimer on there for our compliance folks. So if we look at a little bit of this growth in the market, I want to posit what happened in this period. So I'm going to draw this tale of two periods. One is sort of in up through 21, and then the other is kind of like where we are now. And kind of look at, are those two distinct periods in terms of, financial performance and expenditures of companies. So I'm going to zoom in with some of the big boys, and then I'll talk about how this relates to our world in the private. So I'm setting a lot of setup to kind of build up this point. And let me share my screen in order to bring this front and center. So let me pick up the right. So this is the point of time that I always remind our listeners, check us out on YouTube. I actually had my neighbor find us on Digital Currents. It gave me a screenshot. What a great surprise this morning. Thank you, Mr. Frank. Now we have another dedicated listener. Definitely also check out to see not just if your neighbors are watching, but if Mark or I have been deep faked, what the Bitcoin Soptic is. Kudos to Mark for just being on the ball as he always is. Doesn't matter if it's Friday. Bitcoin never sleeps. It's 24/7, as are the Bitcoin Sock Game reveal. So I will quickly bring this one into focus a touch more. And what I want to display here is what does the capital expenditures look like for some of the largest hyperscalers in 2017 to 21, and how does that compare to 2022 to this 26? Spoiler alert. Oh, slight chart crime here. I wasn't able to get it to be the right size, and the colors are a little close. I don't know, Mark, if those are coming through, but
yeah, I can see them.
There's a pretty big gap between kind of some of the capital expenditures of these four hyperscalers. Microsoft, Meta, Amazon, I'll count as kind of a scaler, although they're kind of, A3 is definitely part of that whole conversation, although they're not thought of an AI company. But gosh, Mark, how many times do we, send each other a text that I wasn't even aware my phone was listening, but I got a recommendation for X products? Well, there you go. That's AI for you for Amazon and Alphabet. Of course, nobody's, mistaking them for anything but AI these days. Even if they have a terrible search engine, they are increasingly pivoting towards AI in that.
Yep.
And what this is showing, Mark, is that there's a very large gap between what happened in the prior 5 years, as in just this 3-year period, huge increase in capital expenditures. But diving a little bit more, this is really a substitute for R&D investment, aka investments in AI. So you're seeing this huge run-up, Mark. This should be no surprise to you as you're kind of in this space, and you're seeing that maybe the scale at which they're investing just in general is just kind of in a whole nother level, where they've outpaced this by, like, the average I'm seeing here is 2 to 3 times.
Yeah. So there's a couple things here that I think are important. One is, as you said, the scale difference in the scaling, in that, all of these companies are hitting that inflection point where the software and hardware kind of go back and forth in leadership. You need a computer to do calculations. Well, then you need to create new software to make the calculation, application better. So we went from VisiCalc to, Lotus 1, 2, 3 to Excel. And so the software gets better. Well, then as the software gets better and gets bloated, then you need more hardware to do it. And same thing with, these LLM models, these, AI has been around a long time, and it really wasn't that great. I mean, other than Amazon and a Pandora, and there are probably a few others where they were using your information to make recommendations, either on stuff to buy or stuff to listen to. And that was a good use case of AI, but it really wasn't that complex.
Right.
Versus what an LLM does, which is trying to, intuit what the words in a sentence would look like based on all this training that is done. So that was part of it. But the part that's unspoken here is, remember, 80% of all the dollars that have ever been created in the history of the U.S., so 249 years, 80% of them occurred in the last 5. Well, that's this period. So we could actually say that these lighter blue, the more Carolina blue bars could be cut in half. That a dollar doesn't go as far as it did back in 2017. And so the difference then isn't quite as stark. And so, if I buy a new car and, 7 years ago, 8 years ago, that new car cost $25,000 and now it costs $50,000, it's still one car, but I'm spending more, but I'm getting the same car. And maybe it's got a few more bells and whistles, and maybe there's some better tech here. But so you got feature inflation, which is just, things are moving faster and chips are better. That's good. But the dollars that you need to spend to get them, there's also a monopoly aspect here that I don't love, and it's very circular. Look at CoreWeave. CoreWeave, right? And Fuego stocks up a lot. 2 customers on here of these 4 are their biggest customers. 62% of all their sales come from 2 customers. Well, if you're sole sourcing, right, if NVIDIA is your only place that you could buy certain things, they can charge you whatever they want. And perhaps they charge an inflated rate. It's like, you go to a really, really good restaurant, you're going to pay more because it's the only one that makes the food, So there's a lot of nuance in this that's important. The one that I do worry about, actually actively worry about, is the circularity of the monopolistic actions. Like if Amazon can only buy chips from one place and that chip company jacks up their rates, then they've got to jack up their rates for the hosting that maybe Meta uses. So then there's the quid pro quo. Well, if you charge me a lot and I charge you a lot, and then we both go up together. So there's a nominal element and a real element that I think is important to keep in the back of your mind.
I mean, tremendous points, Mark. And I think, digging into the numbers, if you add them up between the 4 companies, you're looking at over $1 trillion in capital expenditures between 22 and 26, or 3 times what they did in the preceding 5 years. And the question is that worth it in terms of what it looks like for profits and ability to make money on the stock? Well, I think Wall Street is being increasingly pessimistic because kind of their outlook, their fiscal year has dropped $22 billion on their consensus expectations since ChatGPT was unveiled. So it's kind of trending in the wrong direction. But this was a twofer as I tried to tie this point over to the right side, which, sorry, the title didn't come through. But Mark, this is a title for the valuation of AI multiples versus traditional multiples. And this is kind of a crazy chart. It's got a couple of chart crimes going on here, but I thought it was kind of different. But what it's kind of seeming to suggest here is that we're at a point where the unicorns have stopped making sense, Mark. So if we look at what unicorns are supposed to go into, right? At some point, you're going to be a publicly traded company or you're going to be acquired. If you're too expensive, then you're going to be a publicly traded company by and large. So if we're looking at what's going on in our market in the private side, you have a couple of these massive deals, right? So you have XAI. What is their valuation multiple? 500x relative to their revenue. How about Mistral? 207x. OpenAI 78. Cohere 157. Databricks 39. And Anthropic is a paltry 18x on revenues. So
Bargain.
It's a bargain, right? And so the spoiler alert is if you compare that to non-AI unicorns, the multiple is way down, right? You're kind of, it's still high, you've got some that are like in the 20s, but it's nowhere near what you're seeing with some of these AI companies. And when I kind of set these up, it's to see what's going on in the public markets. Obviously we hear about AI. And on the private markets, we're hearing AI. But when you look at actually these valuations, it's hard for me, Mark, to look at something like these late stage and not think that it's cooked, because I wonder where somebody can exit and make money if the outlook of these public companies is relatively bleak as far as their current financial makeup. But I believe in innovation. But I at least wanted to kind of posit some of these as a dichotomy between, I think some of these are in need of a correction. What say you?
Come on. It's as I like to say, it's just math. I mean, the math ain't math in here. And look, there's a cult of personality around Elon, and yeah, he does get things that other people don't, right? He gets a certain number of chips from NVIDIA that other people can't get. And then the NVIDIA guy says, oh, he's the only one that could string them together. I'm like, well, it's probably not true. But so, maybe there's something more to that. Now, I just noticed it's kind of a little interesting to me that I know there is, in theory, an A in that XAI, but when you just look at it from a distance, it looks like XI, like as in she from China, or the word I use in Scrabble all the time.
Double bonus.
Double bonus, yeah. So it's interesting that's just unique, but the math won't work, I don't believe, for a lot of these companies.
Yeah.
In the end. Now, people say, but Mark, people are making money, right? The Saudi investors are coming in and they're putting money in at these big valuations. Like, oh yeah, they are, but they're not actually buying out earlier investors. So those early investors have paper profits. Now, we'll see, right? I mean, the investors take Circle, on paper have made a lot of money. Now, Circle doesn't come close to these valuations, but the valuations are crazy. So, but they're still locked up. So what's going to happen between now and lockup? I'll go on record saying the price of Circle is going to drop a lot. And then when the lockup happens, it'll drop even more. Doesn't mean it's bad business, just means it's bad price. And that's the difference between stocks and businesses. Right? Businesses are either good or bad, and they can change over time and have good leadership or bad leadership. But the stocks are independent. I mean, not every stock is related to a good business, and not every high price stock is related to a good business, and not every low price stock is related to a bad business. I mean, you can have very good businesses where their stock is undervalued, and you can have very mediocre businesses where stock is highly valued. You can also have really good businesses where the stock stays above average value for a very long time. But my experience says, just because I've been around a long time, eventually the numbers converge because math has to math.
And to that point, Mark, and that's probably a good point to close on, if we're looking at the average between the non-AI unicorns and the AI unicorns. You're at 24x on revenues for the AI companies. They're on a 10x for the non-AI companies. And some of those, in that 10x category are ones that were on IPO watch alert. So it's also the stage of company is also a little bit different, which is not, fully captured. But the idea that you're having a pretty substantial premium given to the IP behind this, right? It's the idea that, well, AI is just going to create some additional alpha beyond what the revenue looks like because they're so far ahead of the market. I don't want to name names, Mark, but recently in our IC, we came across a company that we're still discussing that has no revenues and actually has no product, so to speak. They have an idea and they have some math that could potentially support the idea, and it's around AI, right? And the valuation is very, very high relative to what you would conventionally see at a, I think this is what is his Series A, a seed or Series A company.
Yeah.
And so if you look at, what AI is supposed to be, I boiled it down as to a way to either make more money or save on costs.
Right.
Right.
Yeah.
But we're not there yet. So I think the hope is as some of these companies get a little bit more baked in the private oven, right, over the next couple of years, we're going to start to see them either make sales, and that valuation, I think, is going to slow down. It'll go up, but it's not going to be as dramatic. It's going to start to slow down as it's going to, normalize. To your point, the math has got to work out. Or you're going to start seeing steep reductions, but it'll take time because they raise so much cash.
Again, it's axiomatic, and your point is exactly right in that at the end of the day, every tool either has to save you money or help you make money.
Yeah.
Right? I mean, no matter what it is, whether it's a pencil, a calculator, or a computer, or an AI agent.
Right.
I mean, again, simple thing. I used ChatGPT last night to create a top 10 list of things to see. My wife and I are going to have our 40th anniversary next year. So we're trying to figure out where should we go. And it generated a perfectly nice list of things to do. And we'll probably end up doing one of those. But I didn't pay anything, right? I didn't pay OpenAI one penny for that. It was certainly, that's a little accretive to my life. I probably could have sat down and thought of the same things or searched the internet for a long time. But it was nice that it came up with a nice list. It had a couple ideas that I hadn't thought of. Although it was interesting, 2 of the 10 places it said to go were in New Zealand, which was not first on my list. And the New Zealand got 2 shout outs was interesting. But I do, at the end of the day, if you're not making money or, saving money, then is it really adding value to your business? And I say people can put a big valuation on something, but if they don't get any return on that investment, was it really a good investment? And that's a real, it's kind of like paper gains and real gains. You can own something that in theory is worth, like you bought a house and it's worth a lot on paper. Well, unless you borrowed against it or sold it, it's ephemeral. And in theory, with a hard asset, there's some there, but you actually have to take action and use it. So you can buy a bunch more servers, okay, and maybe your valuation goes up because now you've got more processing power. But unless someone pays you for that processing power or that model, and someday I'm going to have an agentic AI that does the things that I need to do, that frees up my time to be more creative and hopefully make more value in the world.
Right.
And I'll pay for that. And then that's a business. But a tool that is free to me They're not selling advertising, so it's not like Google search. So yes, search is going like this. I mean, search is like collapsing and people are saying, oh, it's dead. Although I do get a chuckle that now when you do Grok or OpenAI or whatever, it says, oh, searching the internet. Like, that's not what you're supposed to do. Remember, you were supposed to be an LLM. You were supposed to just, based on your training, generate a string of words. What are you searching the internet for? So that's interesting in that it's still search. It's just now bundled in a different, UI, UX.
Good point. We'll have to end on that point and wish our listeners a great, when this is released, a great holiday weekend. And thanks, as always, for tuning in. Remember to rate, review, and subscribe. And as always, to stay current.
Thank you for joining us this week on Digital Currents. Check out our links to our website and social media in the show's description box. Please make sure to subscribe if you like what you hear. And remember, stay current.
This podcast should not be construed as investment advice nor solicitation for the sale of any security, advisory, or other service. Investment themes and ideas discussed may be owned by funds managed by the host and podcast guests. Any conflicts at the time of production have been mentioned by the host but are subject to change. Listeners should consult their personal financial advisors before making any investment decisions.